Builders, their superpower is building. Their superpower is 0 to 1. But that almost by definition means that their superpower is not harvesting. One of the things we see with builders, there's a lot of rainbows and unicorns in the builder universe, right? No pun intended. But there's also a lot of mud puddles. You can see the rainbows and unicorns. It's a pattern.
Right.
But mud puddles oftentimes are what take you by surprise.
Right.
When we start seeing small teams that are also trying to be generalists, that makes us nervous because it's really hard. There is a whole ocean that you could potentially boil, right?
When you think about all of these studios now, what are things that from a diligence perspective, you're looking at what is really creating differentiated value versus just the ability to build and fund anything?
I think where we have seen strong value inflection points is around
Hi, Sarah. Welcome. Thank you for joining us. Very excited to have a chat with you today about all things Venture Studio. I think we met many years ago, even before you started the Vault Fund, which is one of the first, we don't know if it's the first, but we'll say one of the first fund of funds dedicated to Venture Studios. That was about 4 years ago. We had met before that, have talked a bunch about Venture Studios over the years, so really excited to dig in. I'll start with the first question. Of all the things you could do in life, why start a fund of funds for Venture Studios?
That's a really good question. I think it's an evolution of interest areas. So my past life was focused very much on venture, but venture broadly speaking as an allocator. And so we were investing in early stage, mid stage, late stage venture. And in the course of doing that, I think as humans, we're always thinking of what is a better way to do this. And over the course of about 10, 12 years, while we were investing in venture, we discovered this business model that was just very consistently returning. And when we looked further into it, it's a disparate asset class, right? So you have wide-ranging performance. There's no real benchmarking. It lends itself to needing a specialist to really dig into the structures, the strategies, the sizing, the process. And we invested in several of these as part of our generalist venture strategy and thought this is a better way. And I think just over the course of being a human, it made a lot of sense to start really focusing in this category of what we call company builders. And that's what led to Vault.
Yes, Sarah, you provided so much, I think, leadership and as well as catalyzing the whole kind of venture studio community. I mean, what do you see in kind of the patterns right now, specifically in 2025?
It's okay. So you guys are asking really good questions. Within the venture studio and company building category, there are a number of trends that tend to happen over the course of years. It's a private asset class, just like venture. And so it kind of tends to take a time to unwind a lot of the best practices and trends. One of the things that we have been seeing quite a bit is this fast cycling within specific categories. So AI is a really good example. Company builders, because AI took off so quickly, company builders were much more nimble in being able to gravitate towards some of the cycling that was happening in the AI category, and still are. We're seeing a lot of adoption of AI technologies, both internally within studios, but we're also seeing a lot more cycling of new companies being built within that specific category. And so I would say, I don't know that this is a trend that's just occurring over the year. I think that this is a trend that we've seen occurring over the past 5 years. But the nimbleness of company builders to move faster within a private asset category that tends to be much slower is something that we like.
Right. Makes sense. So maybe we do some definitions here. So venture studio, company builders, there's other terms for this. you're using company builder. Does that imply company funder as well? Or do you look at this, and you also use the word category and asset class. So what do you, when you say venture studio or company builder, what do you mean?
Yeah, we should be clear about this. So one of the things that we have found is the definitions around the what is nebulous. So the word venture studio often gets used for accelerators and even marketing and brand agencies and entities that clearly we wouldn't consider as an investment opportunity. Where we use the word company builder because as we look into what's really driving the performance of this category, it really is the 0 to 1 ball control, right? So the entity does not have to come up with the idea. The entity does also not have to come up with the funding. It's great if they do, but it's not a requirement. What we see as really driving the performance in this category, and I should be using category, not asset class, because they're totally different. But what's really driving the performance from our perspective is that 0 to 1 ball control. It's what creates the efficiency. It's what creates the repeatability. And those are the things that then create the performance, right?
What about category so you know category and asset class, because we hear both, of course, and other things as well. It's an industry, it's a vertical, it's a seg. So you're trying to lock in on it's a category, not an asset class. So how do you break that down and define that?
So we think about it as a business model. It is a business model that is an improvement upon your traditional venture business model. And it is a repeatable business model that is creating multiple companies within a portfolio from inception. The notion of an asset class, these are clearly shares that are privately held that are meant for high returning alpha over a long period of time. In my mind, it's the same asset class as venture. It's just a better business model.
Got it. Okay, so that's how you're delineating the two things. It's still venture as an asset class, but it's a category because it's got a new business model.
Yeah, in fact, when we think about other investors that are investing in this space and have more diversified portfolios, they're allocating to company builders within their venture allocation. Yeah, it's a similar profile. It's pre-seed.
What signals really separate these studios to have kind of that repeatable value you described?
So where we spend a lot of time, and this is evolving, right? And I think this is one of the variables that necessitates having a specialist. We live and breathe company builders 100% of our time. And we have even learned, like when we first started investing here, we were thinking if we could have a diversified portfolio of multiple assets across with high capital efficiency, right? And high ownership positions, our chances of creating outsized returns are higher. But one of the things that we've learned is the ownership positions are actually inversely correlated with performance. So there's a natural banding of ownership that the company creators should have. But if you go above that banding, you start to see performance dwindle. And so where we are currently, so this is all to say this is an evolution of learning. This is still a very nascent category. Some of the earliest company builders outside of Idea Labs and some of the biotherapeutic builders started in 2012 timeframe. So you're looking at just north of 10 years, which is a full cycle. So there's still a lot of learnings coming out of the model. But where we spend a lot of our time right now, we find that there are two things that really drive returns. One, and the biggest one, is the talent funnel. Who is leading these companies? And this is for the founders and CEOs that are brought in to run the underlying companies. They have to be seasoned operators. And that's where we spend a lot of time. Do they have an appropriate talent funnel? Are they able to match strong founder talent with underlying companies? And then the second is the process. So, and one of the things we will not invest in a first-time builder. We need to see, and we've talked about this, so you're very familiar, but we need to see at least 5 builds, and there's nothing magic about the 5 builds. It can be 3, it can be 10, but the reason is because over time, each building entity realizes where their superpowers are and where their superpowers aren't, which is equally as important. And so the steps that they may take along the way for builds 1 through 5 are gonna look very different than the steps that are necessary to drive scale. And that's why we kind of wait to see how their process becomes more efficient over time. So it's those 2 things. It's the talent and the process.
Yeah, we've always looked at it, the capability to build and also to fund. And kind of when you compare it versus traditional venture capital as emerging manager class and looking at multiple funds, and you're talking about showing the proof points, you have multiple builds. What is your perspective on kind of the differentiated platforms? Traditional venture capital talks about always a platform being built that these funds are kind of anchored to. When you think about all of these studios now, what are things that from a diligence perspective, you're looking at what is really creating differentiated value versus just the ability to build and fund anything?
I think so we invest across biotherapeutics and tech. We don't spend a lot of time in consumer products, and there's reasons for that. But I think where we have seen strong value inflection points is around builders that have natural insights within a particular industry, right? And so, and there's a lot of nuances, which is one of the reasons I'm having trouble answering this question. But biotherapeutics is a good example, right? Oncology is a very specialized category within biotherapeutics generally. And so builders that have historically built oncology molecules will be able to know, like, what are the killer experiments that need to take place? What are the critical components, like within the industry right now? What are the solutions that are needed to start solving specific cancers and specific disease states? And so it's that type of intimate knowledge within an industry that tends to create value faster.
So you're looking, Sarah, in that case for a little bit of, or maybe a lot of, domain expertise, specialization in an industry or vertical, and we can define those things in different ways. But a builder that's building across B2B, B2C, this, that, and the other thing is maybe a little bit shooting all over the place and not as laser focused as you would like them to be.
It can be. Yeah, I think there are builders that have really strong return profiles that are viewed as generalists. Most of them did not start out as generalists. So the notion of being a generalist has evolved over time. And a lot of that is built by, okay, I started something in e-commerce or I started something in marketplaces. And through that, I saw different adjacencies that also needed to be solved. And so it kind of morphs over time to expand. And, I think one of the things we see with builders, there's a lot of rainbows and unicorns in the builder universe, right? No pun intended. But there's also a lot of mud puddles, right? And I think that where we like to spend a lot of our time, you can see the rainbows and unicorns. It's a pattern. But the mud puddles oftentimes are what take you by surprise. And I think that that's sometimes where we like to spend a majority of our time. When we start seeing small teams that are also trying to be generalists, that makes us nervous because it's really hard. There is a whole ocean that you could potentially boil, right? That can spend a lot of capital without a lot of value, Marcus, to your previous point. And so when we start seeing small teams that are trying to do generalist work, that makes us nervous. When we see larger teams that have specialists within each area that have kind of evolved over time, that makes us much more comfortable.
On the topic of mud puddles, I mean, have you seen anything like respect to like, I guess, underrated indicators, right? You're saying like you're looking at things, not the unicorns and the rainbows, and you're trying to unearth other opportunities from a fund-to-fund perspective, looking at these models. Have there been any, indicators that are underrated that kind of stand out, surprising signals?
Well, so what's top of mind for me right now, I'll just be honest with both of you. This category will not move forward and will not expand until there are more liquidity events. Now, all of
You
venture,
don't have to tell us that, but I'm glad you're saying it.
it's something that is not talked about enough, and I feel like I'm screaming from the mountaintops. And I don't know that. So builders, their superpower is building. Their superpower is 0 to 1, creating concepts, creating novel companies, and scaling them with talent, right? But that almost by definition means that their superpower is not harvesting. And if you look at all of venture is hampered right now and for the past 2 to 4 years with having really reduced liquidity options. But if you look at the company builder category, that is exponentially the case. And that's one of the things that makes me really nervous for the category as a whole is there have to be liquidity events in order for other investors to notice the category and participate in the category, right? Investors are not putting their money with company builders to just sit on it for 15 years, 20 years, et cetera. But I feel like that's a lot of the stuff that we're seeing.
Yeah, totally agree. Yeah, totally. Actually, Sarah, it was from your conference, the Global Takeoff Conference, Venture Studios, and a bunch of other folks. And I went this year, and listened to a bunch of panels and conversations about different things, including liquidity challenges. And it inspired me to write a post on my newsletter that we're actually not in the venture building business; we're in the venture exiting business, because we could build all the things we want, and we could be super good at it, and have a super rigorous process, and kill ideas, and pick the winners and find great talent. But because we're at such an early stage, venture builders and company builders, then we just sit and we say like, okay, you graduated out of the studio, and we was sort of like, good luck. And then 15 years later, they call us back with it doesn't make the math will never make any sense. So it really got me thinking about how are we in the business? We have to be in the business of building, but also figuring out how to manufacture exits as well.
Yeah, but the thing that frustrates me, and not to talk so much about mud puddles, because there's also a lot of good things in this category, but company builders are coming in at such a low cost basis, right? By the time you get to a Series A or a Series B, your multiple accretion warrants a potential discount on a secondary, right? If you can return a 20 multiple to your investors on the just invested capital within one asset, why wouldn't you? And that's where I get really frustrated. There are oversubscribed rounds. There are amazing assets coming out of these builders. And even on an oversubscribed round, builders will just sit on their shares instead of like, oh, let's take 20% off the table. And typically in an oversubscribed round, you don't even have to take a discount. And if you're sitting on founder shares, right, there's not even really that much signaling risk. And that's where I start getting confused.
Yeah. What business are we actually in? And to me, like Marcus is about to say, we're in the cash on cash returns business. So I don't want to steal his thunder, like his line. He's got a couple of good lines that he uses, but I think maybe venture builders forget what business you're actually in. You're there to return dollars to investors. That's the business.
I think obviously you've heard that line many times, Ben, but I think I have a theory, Sarah. I mean, I think a lot of people who get into venture building, like you said, they're builders. They've never actually been institutional capital allocators. So they miss a bit of that experience in thinking if it's cash on cash, or, how do we really measure the value of our portfolio? And then look at kind of these hacks to get partial liquidity, right? I mean, it's something that we're ingrained in because we've raised institutional capital. We are GPs. So we're GPs and builders. And I think that experience and that kind of institutional investor experience sometimes is lost in the composition of studio teams. That's one thing that I see.
That's a really good point, and one I actually hadn't thought about. But yeah, if there's no one in the team that has experience working with institutional investors, which a lot of times in these entities, there's not, right? We see entities that are, we've seen entities that are $2 million targets all the way up to $300 million targets. So, and there's a huge range. But if you're working on the lower end of that scale, you might be working with one or two people that are just used to creating companies and they're not used to working with institutional investors. But that, Marcus, and this is one thing that I'd love to dig into, especially if you have a strong opinion here, that is what the category will have to have in order to move forward. Otherwise, you're only ever going to be exposed to individual investors and family offices, right?
100%. Yeah. I mean, when Ben and I co-founded Highline Beta almost 10 years ago, and we were very conscious about, okay, how do we create this differentiated platform? Working with corporates doesn't mean a natural pathway these ventures are going to exit, but it did at least push the envelope of how we thought about how these ventures would get co-funded, and also measures a time, like you described before, how can you get partial liquidity to drive in returns? I mean, when we started, we delivered, after 18 months, 2x back to our investors. And so that got the level of confidence to continue with us on this journey. And it's been a roller coaster. I mean, but we're, pretty proud of the portfolio we have, and we're learning every day specifically about how these models are changing with SPVs and other, family offices entering it, like you described as well. So it's early days, but certainly I think you do need to have that vision on how do we harvest that, to Ben's point, and I think the great blog post that he wrote, we are in the exit business. We're not just here to build. Otherwise, we should just build companies and not take other people's money.
Right. I don't know how, and maybe you have a better idea as to how to do this, but how do you get that message across to the builders so they view it as important for their own growth?
Well, it feels like it's going to happen after about 5+ years into building, and you've built X number of companies, and you're like, wait a second, I'm broke. Like that's probably how it shakes out, I think, for studios that don't realize they have to drive some of those returns. But also, I think and again, you've talked about it before, and others have as well, that there is a model here because of the equity that most studios are taking. Maybe, and I want to get to that band and range that you think is, or you've seen as ideal from the performance perspective. But because studios do take a little bit more equity than, just a straight up investor, there is an early exit opportunity, whether it's exit the whole company early or, to your point, secondary. And I think it's just getting into that mindset. But I think studios will just learn, because they're going to have to fund operations somehow. You can fund it from returns, you can raise capital, but if you raise capital, those investors are going to be like, where's my money? Like it's going to come down to people getting a return somehow or not. And I think it will shake a lot of studios out, perhaps.
That's a good point. Maybe it's just the maturity of the category. And over time, I mean, it's really not that mature, especially compared to traditional venture. So like maybe over time, this does just shake itself out.
I agree with that. I mean, I think it's going to become a bit Darwinistic. I mean, there are, call it 1,000 studios and different varieties. But ultimately, like you said, there is something magical in that 0 to 1 is a new business model. And I think it definitely deserves its place in the spectrum of venture. And it'll be interesting to see again, naturally, we're very biased in working with lots of corporates. Recently, we've been working with a lot more family offices in different countries all over the world. So you also have kind of the maybe unsophistication also in other geographical markets that are now looking at this model as being a really interesting way to drive, returns or find differentiated alpha. But, just given, you brought up the liquidity thing. And I think, since you would love to shout this out loud, again, we should probably spend a bit more time with it too. Have you seen any interesting liquidity hacks that studios or even other venture folks are doing beyond like the classical secondary?
Well, so like Andrew Black from Brand Project spoke at the summit. You may have seen him. Now he's doing secondaries as a means to fund his operational expenses. But in that, he's doing secondaries and oversubscribed rounds with no discount, which I think is brilliant. One of the things we have seen also is a predetermined secondary, almost like there's a signaling risk in the general venture marketplace. For instance, if you get funded by a Series A fund and they don't participate in follow-on in the Series B, unless they say, we're only doing Series A, no reserves, right? And they say that at the outset. So similarly, there's a limited signaling risk when you have builders that say at the outset, Series B, we're selling 20%. Right. And it's predetermined regardless of where they are in the cycle at Series B, wherever the valuation is, wherever their holdings are, they're selling 20% of it. So we have seen that work well. There often has to be an appetite for those shares at Series B is the problem. So I think one of the things we have seen also that we like when it works, I think the challenge is it rarely works, is strategic partners oftentimes can be quite acquisitive if they have the right assets that are being built internally. So where this has been, I think, most applicable in our experience is with hospital systems. Hospital systems tend to want to adopt like patient experience capabilities very quickly. And they're able to integrate them in. They're more acquisitive. We see this also in biotherapeutics with pharma, right? And biotherapeutics is a really interesting profile that is staunchly different than tech. But it's something that I think the tech should really look at more because there are so many advantages in bio. Bio tends to take more capital, but they also take more ownership. In bio, you might see 70 to 90% ownership banding, and it's not counter-indicative to your performance, right? You're dealing with different types of talent. You're dealing with scientific talent. And it's also a very regulated, like you're building molecules. So it's a very regulated process to build these molecules. But pharma will come in readily, right, around certain indications and certain phases that are reached and certain data that is met. But also bio has faster access to liquid markets through using public markets as a financing strategy, which becomes less dilutive than if you were trying to raise additional private capital. So it's a really interesting juxtaposition. But I think that in the bio category, we see liquidity much faster. It tends to be around like 24 to 36 months.
Yeah, it's super interesting with respect to the different industries. And I think also one of the challenges sometimes with strategic is how do you actually value? Because normally when they acquire, they're looking at very different valuation multiples or just metrics and how they value the asset they bring in versus the classical venture. So if you had a traditional venture capitalist leading a Series A at, maybe on a convertible note or a pretty high value cap, then what does that translate afterwards? Does that make sense? And I think it's, like you described, it really is subjective to the industry.
Yeah. I think it's very subjective to the industry. Like for instance, one category we've seen be very hard is in deep tech and deep sciences, because it tends to have the capital requirements to get from lab to commercialization. It tends to have the capital requirements of bio without an active buyer
Without the buyers on the other side.
Right.
Perfect combo. Yeah.
It's like the worst of both worlds. We've seen it very short. Now we have seen a few models that have started coming out that basically are able to either really shorten that capital need through using international markets or through using non-dilutive capital. And basically the key is to get from lab to commercial revenue as fast as possible. But oftentimes that's where going from lab to field is very difficult in deep sciences, we found.
I do like the idea of designing the secondary into your plan. Of course, there has to be a buyer at a Series A or a Series B, but I think that speaks to maybe the rigor with which studios are going to have to start designing themselves. So instead of saying, "Hey, we're just going to build great companies and then see what happens," it's we're going to build great companies, but we're going to put in a line that says we will exit 20% if available so just the rigor and the sophistication of the rules you set up for yourself and the rules that you're playing the game by, instead of just being like, I love building, and then, liquidity is somebody else's problem. It's like, design it right into the model.
And Ben, that's it though. That's exactly the point. By speaking about it more and having it in your head up front as to like what your strategy is, your strategy may not work all the time. No strategies do, but it's going to work more often than zero.
Yeah, but no plan at all. Like no plan at all. At least designing it into the model of the studio says we've thought about this because we recognize how hard liquidity is. But if we don't get liquidity, we're not an investable studio, and then the whole model breaks down.
Yeah. So one of the things that we're doing is we're starting to sign side letters with all of our GPs, whether they're a holding company or a fund structure, that they're having a strategy in place. And that strategy can look like we're going to sell 20% at Series B. That strategy can look like we're going to have an exit committee that's going to review exit opportunities. That strategy can be like, at funding rounds, like it can be anything. But that is exactly the concept. It has to be in their head when they're starting companies as to how they're going to exit. Because this notion of going along for the ride, being an early stage venture investor for 15 years, I can tell you that doesn't work out well because you are the first investor. So by the end of this journey that your build is on, you have zero control over the outcomes. And those that do have control over the outcomes, i.e. the later stage investors, really don't care too much about this entity that's, from day zero.
Yeah, and I think the point you made is so important too, because a lot of builders don't really even understand the preference stack and what happens. You take round after round after round. And so you have this common equity that's sitting there that you're never really going to get liquidity to. And then your return profile basically, falls apart. You brought up a really important point, even a hot topic earlier. This is deployment of capital and pacing, because I really think it ties into that strategy that's going to link into liquidity. But, do you do follow on? Should studios reserve more capital for follow-on, or should they write a bigger check in earlier in that 0 to 1 phase? I think there's a lot of active debate, and I know you're so close to the data.
Just tell us the answer. Just tell us the answer.
Yeah, I think everybody, our whole audience would love to know the magic answer.
So Francisco, I wish Francisco were on the call too. We should have him, if we do this podcast again, we should have both of us on here. This is an internal debate we're actively having.
Okay.
I tend to lean on the side that your follow-on reserves matter less than your initial investment. In fact, one of the things that we're seeing right now is too much capital in the company building category is a disadvantage because for two reasons, right? One is you are not pushed. There's no sense of urgency in getting your companies ready and out the door for external rounds, right? That is a huge disadvantage because it creates, especially the duration of startups in this era is so limited, right? There's no more like startups that are going to be relevant for a 10-year period. And so if you don't have a sense of urgency to get your companies ready and out the door because you have too much money and you have too many reserves, it's a disadvantage. The other one is we, on a net basis as LPs, start to suffer from multiple compression, right? So at inception, your cost basis is so small. The multiples on that are going to be fairly large. Now, the reason to argue, so as you do reserves down the road, the multiples come down and down because your entry point is higher, right? Obviously. The argument for reserves, so that's my opinion, Marcus. We'll just leave it there. But the argument for reserves in company building specifically is to maintain ball control for a longer period, right? So you're not necessarily just a pay to play or wiped off the cap table. You're still a relevant investor in active rounds. And that actually has a very large impact in getting your companies up to a specific point. So that would be the argument for reserves. But from an economic standpoint, I don't know that it matters as much as the quality of the companies you're building.
Yes. Yeah, that's exactly it. I mean, I'm leaning more towards having less reserves. And I think the quality of the work you do in that 0 to 1 phase and then help the startups get to go to market. Can you get them further along? And how many more cycles of funding rounds do they need to have? And hopefully there's a right balance, in protecting the ownership that you have there. I think also that's one of the challenges that, I think the whole categories you described still have it is when you communicate this to LPs, not yourself because they're so sophisticated as a fund to fund into studios, but traditional LPs, and a lot of them want to have side letters and they're pushing for more ownership and what's your reserve strategy, like a traditional fund, when the dynamic is so different. So it is definitely one of those things that Ben and I are thinking even more deeply about, and finding that right balance in the advent of AI, given our cost structure has been reduced in how we're building companies.
Marcus, are LPs pushing you to have more ownership as a studio? They want to see you have higher ownership positions?
In some of the conference, not more ownership, but I think it's more in the sense of having more reserves for follow-on to protect, like a traditional fund.
Oh. Yeah, the debate is real. I mean, the debate is real. There's definitely two sides of the argument here. And, I would argue, well, we could debate it all day, but
Well, like you said, it's nascent, right? Like it's such, we still need and I think that relates also to the idea of the data behind all of this. And, you've accumulated so much wonderful data over the years and have a great perspective on this. One thing I always see is always people are talking about the success of the model, and it's better than traditional venture capital. And people throw a lot of metrics out there. And, we have an institutional funds, which is audited, which has a really conservative valuation policy. Now, I can only imagine the spectrum of data that you're seeing. Somebody's marking up that last round. So how do you compare? Do you see more sophistication in the studio company building world in the data that are getting maybe financials audited or more conservative valuation policies, since most people are builders?
I mean, all of our studios, whether they're holding companies or fund structures, because we have both, they're all audited. I think the nature of private company valuations has a lot more qualitative aspect to it than public companies. So, but I would say the sophistication around the financial aspect of it is fairly similar to what you would see to traditional venture. You're valuing private companies and you're valuing kind of baby private companies. So, as our auditors always tell us, at some of the earliest stages when you have no data, the valuations really aren't going to move the needle. It's once you have data down the road and you can really start assigning real values to companies is when it starts to matter. And I think that that's very similar. From a data standpoint, so at the summit, we presented a bit of our data. It was mostly application data. I would say in this category, and Ben, to your question earlier, we are starting to see, and over time, as categories mature, you should start to see banding, right? There becomes very, very obvious best practices. And one of the areas where we're seeing the most banding right now is in that ownership take rate, right? So when we first started investing here, we were seeing builders on the tech side that were taking 80 to 90% ownership. And that's a non-starter, right? It really disadvantages the company. They can't go out and raise external funding. The founders that come in tend to be junior. And so where we've seen that very much come down to 25% is what we presented at the summit. And I think, the benchmarking around this has been around like 33%, down to 30, down to 25. So it's coming much more in line with the traditional venture marketplace. And that's a good thing because the cost basis is lower. So the alpha is naturally going to be higher. You don't need high ownership percentages. I would say the other area that is not banding at all, which is a surprise to us, is structure. So in traditional venture, you have a 2 and 20 model, and that's what you have, right? Anything outside of that looks funny. But in company builder world, you have holding companies, you have 2 and 20s, you have dual entity models. And It's all over, and it hasn't even started banding yet. And we're like, hey, it's been long enough. There should be like a best practices here. We started out actually loving the 2 and 20 model because we knew it. You had 80% upside, right, on a net basis. But one of the things that we found through Fund One, which is super surprising, and we haven't talked about this yet, but I guess not surprised. If we would have thought about it, we probably would have figured it out. But these 2 and 20 models are using the 2% management fee, which is not equity bearing on a net basis to us as LPs, to do the discovery, ideation, validation, and launch work. So, as on a net basis as LPs, we don't get access to those assets until they write a preferred equity check at launch. Our cost basis then becomes higher. So the manager's cost basis is lower, our cost basis is higher. It creates this natural conflict of interest. And we want inception stage, right? We're investing in them because of their discovery and validation process. So we want access to that. That's where we see the value. And so we've started really gravitating towards a holding company model because everybody's pari passu at parent company, right? And in the holding company model, there is a wide dispersion of ownership, right? You've seen like 10% ownership by capital. We've seen 65% ownership by capital. We've seen 90% ownership by capital. And I think it's an area where we unfortunately have to spend more time than I wish we did.
I seem to remember at the summit, somebody, I can't remember who it was, saying, let's stop talking about structures altogether and just accept the fact that there will be a variety of them. And I'm not sure that's the answer either, but I remember somebody saying that, like, we have to stop debating structure, but it's so important to everything around us. Like, who will invest in a holdco versus a fund? Like you said, 2 and 20, I understood it, so I could invest in it. Holdco, weirder, I'm not going to invest in it. And we see that with, LPs, right? So that's important. Like, how do I get money into the studio? But then the economics of it have to be explained differently. And the 2% management fee might not cover the operating budget. Like, it just goes on. So I don't know how to not talk about structure. I don't know if we'll ever find banding and the perfect model, but it seems to me like we have to keep talking about it, educating the market on the options, and seeing what makes sense.
100%. And with both of them, like fund and holding company, there are best practices within those models, right? And I think it depends very readily on the strategy and the sizing. And that's why we're seeing different structures. Not everybody can go out and raise 300 million. And I would argue you don't need 300 million if you're doing inception stage investing. It's not needed, right? And so I think they're probably to help the category grow, there needs to be both because there's both types of investors. But I think within them, right? Like, we would love a fund if a fund gave us exposure to inception stage and didn't use the management fee to do it.
No, that makes complete sense. I mean, again, I think it also comes down to some of the things you described with what is the future of this kind of category and these different, where liquidity comes from, right? Because again, what is the end of life of a fund? Is the traditional 10-year fund with 2-year extension, GPLP structure, really the answer at something that's being born at before pre-seed, institutional capital coming in? And then on the flip side, the holdco, when's end of life? Like, how do you liquidate the holdco, or is that evergreen? And so I think to Ben's point, I think there's always going to be these different structures, and a lot of it also might be dictated by the industry you're in, which really would dictate on just, again, what is that return profile? Are you harvesting too early, or you need to have a continuity vehicle that comes in after? So it's a lot where I spend my time these days with all the different vertical venture studios and trying to map it out, where we try to get some consistency into the repeatability of how we build and architect different studios with corporate partners, family offices, and for ourselves.
Exactly. Well, and there are LPs that simply won't invest in holding companies, right? And because they can't, they don't have a valuation mechanism. So I understand and I empathize. I think there does have to be both structures. We have our preferences and other investors have their preferences. So
And the banding is interesting. It didn't surprise me that it was going down, again, like to that 25% average sort of position. I think that's probably a good thing, and I think you had said 33 was what you were sort of tracking before, and it's starting to go down. So I think that, tracking that data, because you see a lot of studio opportunities, makes sense. I think some of the data that we question maybe is like the exit, like the value returns on stuff. I think that data is so early, and of course self-reported. And so, again, people say studio, I mean, we're all biased because we're in the business. We think this will generate better returns than, traditional venture capital. That data, I think, is still probably early stage.
Yeah, the TVPI data, is that what you're referring to? Yeah. Yeah, the TVPI data, we see that's where you see the most dispersion, right? And I think also in IRRs, which, I mean, they're both based on the same numbers, but where I get nervous is you do in private assets, period, regardless of whether you're talking about company builders, venture capital, private equity, you tend to see this natural upslope in early stages of value, right? And so you go from 0, you go to 5, 10, 50, 100. Now, the durability of these private assets is incredibly important. And one of the things we're starting to see now is the durability in private assets is shrinking. So when you get up to this $100 million mark, if you don't have an incredibly durable asset, what you start to see is a flatlining. And then over time, competition comes in and gets better, and you start to see a decline. And so that's where we start to get very nervous. When you start to these high TVPIs, they don't make me nervous. And I know the data, I see the data. It's largely driven by some really outperforming builders that come in at very low cost basis and have high multiples. That's the nature of this business model, right? But where I do start to get nervous is in the hold times, because over time, those hold times are going to really inflect your value, and you're going to end up with what looked like maybe a 20 multiple is now exited at a 2 multiple. And we see this all the time. And that's back to the point of you're not in the business of holding capital. You're in the business of returning capital. And you have to get that mindset. Otherwise, you are going to be returning 2 multiple over 20 years, and the whole category is going to cease to exist.
Let's not go there. That's not. We'll avert that. I know, Sarah, we only have a little bit of time left, so very, very quickly, few predictions for the venture studio, venture builder, company builder model over the next couple of years. What would those quick predictions be that you're looking over the horizon into 2026? What do you think is going to happen?
We're starting to see a lot of what we're calling concept creation, where essentially builders are coming up with novel concepts, but they're using existing companies to execute on those concepts. The economics of it are incredible. I think it's going to come out as a best practices, and it's something that it tends to scale, and it takes a lot of risk off the table, right? You no longer, sorry, this is a longer winded, you said quick answer.
Help me understand what you mean by an existing company, new concept. We'll just talk about that. We'll have to have you on the podcast like 5 more times. So let's just help me understand what you mean by this particular idea. It sounds very interesting.
So we're seeing company builders that are saying, hey, there is a real opportunity to drive more automation in primary care, right? It's a clunky, old industry. It's very decentralized. So our concept is to drive more automation, to drive more centralization in primary care. We're going to do that through existing primary care facilities, right? But we're going to use existing businesses, and we're going to essentially automate them and create a better patient experience within that existing business. So you're taking technology risk off the table, you're taking market risk off the table. Really what you're focused on is execution risk. And the ability to get from 0 to 100 in that model is so much faster. The economics are really good. I do think it's going, and we talked about this at the summit. It was the private equity and company building.
Yes. Yeah. That's yeah. Totally
Yeah. It's a I wouldn't say it's a huge trend right now, but it's a trend we're starting to see more and more of. And I think it's going to become more of this company builder category over time.
Right. Makes total sense. Amazing. Well, Sarah, we're at time already. That was fast, but great conversation. Really appreciate it. We'll definitely have to have you and Francisco back on, and maybe we'll just do a debate on follow on or no follow on, or maybe you'll give us a couple of other things that you guys are arguing.
Options, yeah.
Yeah, these are all the things that the people at Vault Fund are arguing about, debating,
Yeah.
and we'll go after those and figure it out. But thank you so much for your time. Super insightful and valuable, and look forward to learning a ton more from you in the future.
Thank you both. This was so fun. I appreciate it.
Thank you.